So, you've just inherited an IRA. Now what? Hi, I'm John Norberg and welcome to the Financial Prof series. So today we're going to talk about 3 things that you should keep in mind if you've just inherited an IRA. So let's get this started. First things first, let's figure out what kind of IRA it is. If it's a Roth IRA, you've got a lot more flexibility because those are post-tax and you can take out the money at any point over the next 10 years without any tax impact. But if it's a traditional IRA, which is the assumption I'm going with, since the majority of cases I see come across my desk are traditional inherited IRAs, then there are especially some things you want to think about, especially number 1. First thing on our list, breathe. Don't take everything all out at once and put it into your bank account. So unless you're absolutely required to, let's say it's getting close to the end of the year and you've got an IRS required minimum distribution or something of that nature, it's probably a really good idea once that IRA actually transfers into your name to just let it sit for a few weeks or a month. Just don't take anything out, and especially don't take all of it out without having some kind of plan. Now, what that looks like actually brings us to point number 2. But before we get there, why don't we want to take everything out? Well, let's say it's a nice large IRA. Whoever our dearly departed relative was perhaps did very well for themselves. Let's say they left us $1 million. If we took out $1 million and plopped it into our bank account and figured out what to do with it from there, at that point the IRS is going to consider that a taxable distribution. And that means that $1 million is getting added to your income for tax purposes that year, which is going to translate into hundreds of thousands of dollars in taxes for you. So that's why I say step 1, breathe, and don't take everything all out at once. So step number 2, sit down with a financial advisor and listen to what he or she may have to say once you've told them about what your goals may be. So it's really important to figure out where this IRA fits into your financial goals, and then to engage some third-party expertise, because I certainly don't know everything about, let's just say, cars, and I take my car in to someone who does know everything about cars. My auto mechanic's pretty great. Hi, Frank, if you're watching this. The other piece of it is, if you don't listen to what they have to say, great, maybe get a couple of opinions, but do at least have some kind of third party who you can talk to and listen to what they have to advise you, because this is going to be helping you formulate your opinion on where this piece of the puzzle fits into the overall financial goals. Whether that looks like a home upgrade, or a new car, or saving for your children's education, whatever it might be. A licensed financial advisor, hopefully a certified financial planner such as myself, will be able to help you figure out where that piece fits in with everything else you'd like to do. Now that leads us into step number 3. Once you've sat down with an advisor, after having not taken everything all out at once, and you've started to come up with a plan for how this fits into your overall goals, then step number 3, the rest of the picture. In other words, make sure you've got all the housekeeping items done that you would normally do anytime you're setting up any kind of new account. So the first thing that comes to mind is set your beneficiaries. That's a really simple, easy one that a lot of people actually neglect and can add to the overall estate cost if you yourself were to pass away unexpectedly. Another one, and also a really important one that should be part of step number 3, and should lead out of step number 2, have a strategy for how you are going to get the assets out of that account. Now, this is actually really important because whereas before you used to have your entire lifetime to take those assets out, whether it's a Roth or a traditional IRA, the IRS now tells us we have 10 years to take out all of that money. So maybe this looks like having a tax strategy where you know you're going to have a lower income year coming up for whatever reason. Maybe you're selling a piece of the business at a loss, or an investment that you're selling at a loss, or giving a large amount to charity, whatever that could look like. That would be a great year, for instance, to take a larger chunk out of this IRA, because then your tax buckets remain essentially the same. But essentially, at the end of 10 years, everything has to be out of that IRA. And also a housekeeping item, the IRS has recently given us a rule that we have to take out every year an RMD, or required minimum distribution, from that inherited IRA. So part of step 3, housekeeping, make sure that you've taken this year's RMD if you haven't already. Now, good news, they haven't actually enforced this rule yet because it's still pretty fresh. But if they don't do so this year, they're very likely to start doing so next year. So especially if it's getting close to the end of the year and you don't know, if the person from whom you inherited that account has taken out the RMD for that year, make sure that you contact your financial advisor or the custodian who's holding the account for you and figure out if you need to take something out this year in order to remain compliant with the tax situation. So again, step number 3, it's everything else, the housekeeping item, beneficiaries, having a plan, a tax strategy, making sure you're taking out year by year what you have to, that small chunk called the RMD, required minimum distribution. So if this was helpful, and let's say you did just inherit an IRA and are figuring out what you need to do next, give us a call here at Norbert Wealth Management. We're happy to sit on down, listen to what your situation is, and help you figure out, like I said in step number 2, how this fits into your overall goals. And in the meantime, I'll see you out there.